which is that all those investments in those basic research labs uh, uh, don't really have a quantitative yield. In other words, inside the company, it's very difficult to show exactly how much you're getting back. But we know historically how we got there, and so from a cultural point of view in the company, everybody knew they had to support it because that's why you were able to hold that market position. You kept on investing in your area, and that's how you did it. But now a new generation's coming in, competition's coming in from uh, from all over the world. Japan and Europe have reconstructed, and they can use the same science commons as anybody else. And all of a sudden, what's great for operational companies, remember we talked about how these companies are now starting this phase where they're going to become operationally efficient, which is that if I don't have to invest in research, but I optimize how I bring technical results to the marketplace. And then later this becomes, how do I not do anything in the medium term either, and I just optimize outsourcing factories and minimizing cost. So this is the beginning of that cycle. And what's interesting here is that a very competitive marketplace is great for bringing a lot of value when you're going from this kind of phase, an innovation phase, into a operational efficient phase. It obviously takes a lot of innovation that's been pre-invested in and brings it to the marketplace at a very low cost. And so you have great innovation productivity. And actually it's deflationary in the sense that what it does is people are getting more and more benefit at a lower and lower price with time. And the thing that really aided that was the rise of the rise of the information age paradigm. So the information age paradigm is an innovation paradigm that carried us from late 60s basically up until modern times. And so it all goes together because what was going on is that these large companies with competition had to cut back. Plus, when they finally were forced to do the calculation, it was very difficult for them because, you know, this innovation process we're talking about, we've talked about how it's difficult to record accurately historically. It's tough to show a dollar invested, 15 years out resulted in this whole new business. It's kind of complicated because of all these factors in market implementation and technology, including things that come from outside. So generally the feeling was we have to cut back to be competitive because we're doing research, but our Japanese competitors are not in the same way. And so this created the collapse of the commons. And some of you probably heard the story of the tragedy of the commons in the old New England towns. We'd have these big town greens in the middle where people used to, in the 1700s and 1800s, bring their farm animals to graze. And everybody take care of the commons together. And by having that scale, everybody benefited from each other. But of course, eventually, one farmer starts saying, hey, you know what, they take care of the commons. I don't have to put any money in. I'll just have my animals go there and eat the grass. So what happens over time is more and more players figure that out, and they keep on putting no effort into maintaining the commons. And of course, what happens is very quickly there's a spiral because everybody's taking out, nobody's putting in, and the commons disappears. And so that's called the tragedy of the commons. And so remember that scientific commons I was talking about starts to disappear because the corporate folks are not investing anymore. However, the things that are in the pipeline, like our strained silicon, by the way, are able to move forward because capital finds a way. So, this next phase, I would call it innovation absorption, because you sort of have, from a financial point of view, a gigantic dilution where the original organizations that created the scientific commons create a lot of ideas there and even develop them part way. They get wiped out. If you think about it, nobody records those innovations. So, for example, in the strained silicon example, we'll throw out the fact that AT&T invested in that over 6-7 years, right? And we'll throw out any kind of contribution from IBM sending its fellow to Cornell and all that, right? So boom, 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 wipe it all out. So one way to think about this time period is you get very high yield because a lot of the previous investments aren't recorded. And so you end up with a lot of capital being able to follow different ideas, especially in the information age paradigm, where the parameters for what you need to invest in are better defined than when you don't have a paradigm. So for example, what kind of integrated circuits, what kind of software, what kind of boxes, you're just building one level of hierarchy on top of another. And even though there's some uncertainty there, it's a lot less than, like, say today, where, oh, I got to find innovation somewhere in the world in any sector and invest in it. That's a lot more difficult than being in the information paradigm and saying, ooh, I wonder which operating system's going to win. Like, they're at a different scale. And so what happens is small companies come along and start forming to take advantage and to bring this technology to the marketplace. And in Carl Schramm's language, again, we're going to call this phase of the U.S. the entrepreneurial capitalism. So what happens in entrepreneurial capitalism is that with all these previous investments, putting stuff on the shelves, whether it's Apple Computer taking Xerox's stuff, or whether it's Strain Silicon going into a small company, eventually finding its way into first microprocessors and then other chips. All these things essentially are absorbed finally. So the way to think about it is that the first stage, which is innovation, fundamental innovation, was actually very efficient in the early stages of bureaucratic capitalism, but they were brought to market through entrepreneurial capitalism, which we're calling here innovation absorption. Huge yield, production of lots of investment yield. Well, of course, the problem, like I said in the last lecture, the previous set, was that this is great, but these kinds of companies and this kind of investment, the yield go down if I have to invest all the way back into fundamental innovation. So that's what starts to happen in the 90s. Towards the end of it, we start investing either in trivial incremental innovation because of the hype of entrepreneurial capitalism, and also some of the companies are actually doing quite fundamental innovation. And because of the timelines involved in fundamental innovation, as we've discussed, the yield goes down, and then incremental doesn't produce as much yield either. So all of a sudden, capital stops going in the same way, and really it's the end of the post-World War II innovation ecosystem for the United States. So what's been going on since 2000 is the breakdown of the U.S. Innovation system. And people still are not really wanting to look at this. We're still blaming all sorts of other things. But let me tell you what's been going on since 2000 so that we're all aware of what will come soon. So in 2000, we have the overestimation of value in forward-looking innovations, because remember, we had those pre-investments. So if you go back into the 80s, you sort of have a situation where let's call it essentially medium scale innovations were undervalued because they had value invested from the previous innovation ecosystem in a variety of ways, but you're coming from days in which all market dominance was from large companies. And so they were undervalued, which allowed, of course, in the 80s and early 90s, essentially large venture returns through entrepreneurial capitalism. problem comes in that through the 90s, as things started slowing down, we started doing something which was called monetary easing. So through the 80s, there was a feeling and a memory that we need to keep the currency, the US dollar, which is the world currency, stable, because we saw the errors of the 70s. In fact, what happened in the 70s was that when large bureaucratic capitalism started to slow down, and we needed entrepreneurial capitalism to take things on the shelf and bring it to the marketplace, what you saw was a low return on investment. You know, AT&T stock just didn't go up the way it used to, and HP stock didn't. And yet these small, medium-sized things fortunately came along, and they started doing it. In the 70s, in order to get that process started, we had to get control over inflation, because the first thing that happened was the government was creating too much dollars, and we had great times of inflation. And then in the 80s, it was realized we have to create stable currency, and so that's cool. The memory lasted through the 90s, but what happened in the 90s, towards the middle and end, was that things were slowing down a bit, and so we dropped interest rates a little bit along the whole time. Now, why does it help? Well, what it helps is that, let's suppose that you're a company and you're, I don't know, I'll just make it up, but you're returning 7%, so it's a fairly mature company, and I return 7%, so you know, whatever dollars I take in, I'm able to produce, you know, 7% of operating profit or something. Well, I'm kind of getting, all of a sudden, you know, my margins are getting close, because let's suppose that that capital cost me 6%. So, you know, I have to borrow at 6% if I want to expand, but I'm only returning 7%, so it's getting kind of close. So what the Fed can do is say, all right, let's lower this to 5%. Well, now, all of a sudden, there's more margin here. Now, what do I do with that margin? Well, what the Fed is hoping, or I thought would maybe think would happen naturally, is that you would do increased. Unfortunately, that's not what happened, but this difference was distributed. Now, there's a good part of that, and that actually helped drive venture, which, you know, went to smaller companies that were still able to find seeds. But of course, eventually there's no seeds. So what happens at the end of the 90s is that you have medium and even incremental overvalued. That is, because of the success, we start to drive up prices for investment. So these dollars that are being made on this actually aren't being invested in the original bureaucratic company. They're being distributed. The individuals that are lucky enough to get those distributions are generally, you know, people doing well, or putting it into 401ks where investors invested, and then, you know, some fraction goes to venture. But those ventures are now, the number of seeds left out on the shelf from bureaucratic capitalism are getting less and less. If I invest in fundamental innovation, clearly I lose, because the time scales are too long, and even the medium and incremental innovations are overvalued anyway. So what happens in 2000? What happens in 2000 is that we have what's called a tech bubble crash. So this is when we should re-kick our innovation system into doing something new, because when this crashes, you know, essentially the innovation pipeline is empty. This should mean that cost of capital for things goes up. But instead, there's a bunch of things like 2001, 9/11, and just the effect of what the Fed was doing in the late 90s. Their idea was let's lower interest rates drastically to inflate, essentially, again. And so the same process I'm talking about is, instead of forcing people to turn to innovation, market wants to do is force longer term innovation investment. But instead, we lower rates, and what that does is encourages the operational corporation. It also encourages incremental innovation. So essentially, this gets overpriced again. This is a classic example where, even though in the late 90s companies that didn't make any revenue were overpriced, all of a sudden, by 2013, these are overpriced as well. And along the way, we had real estate that was overpriced, etc. So what's happening here is that nobody's being forced, because of ever decreasing interest rates. Nobody's being forced to make bets. Now here's the problem. Say, well, wait a minute. I thought if you could borrow a lot of money, it's so cheap you would invest it far out. But of course, the problem there is that a corporation is forced to say, well, if I got cheap money, I just reduced all my costs, so I can actually make my numbers and I don't have to invest in the future. Now, you think at the bottom, if I look at interest rates or something, and now we're out here and we're at some minimum, everybody knows we're at some minimum, you would say, well, can't go any further, so I better invest in innovation. The problem is that a lot of them are saying, well, I got to stay on cash, because the one thing I do know is when interest rates go up, all of my costs are going to change, and I actually can't make return, because now, with this continuing slope here, I've taken businesses that I've had, and let's suppose the natural money rate's here. I should have forced myself to innovate when they dropped to this point. But what I've been doing is expanding those businesses, because the interest rate keeps on, my cost of money keeps on going down, essentially, so I can keep on expanding my current business. So essentially what this does is, if you look at it from an innovation perspective, it delays the reallocation of resources that the economy is trying to do to get people to risk and do more of the iterative innovation process long term. But it keeps them occupied by keeping them in their current positions, even though they're only doing incremental innovation, expanding current business. Now, of course, when it goes the other way, eventually this will have to turn around, because now, let's suppose you're here, and let's suppose like 7% interest rates. Well, I better have a business that returns like 50% margins or something, if I really want to take off. Or even for older businesses, I better be able to figure out how to get 30%, right? And the problem is, without innovation for any length of time, you're never going to achieve that. Now, given that fundamental innovation, remember the story, that fundamental innovation after the aha moment. So after the aha moment, it still takes 10 to 15 years. So it's likely we have a period then where what's going to happen is a lot of companies are going to fire a lot of people to try to maintain at least profit or break even. Unemployment will go up, and a lot of those people will be forced to go do novel, innovative things, and eventually we'll have a correction because some new things will be discovered, and we'll enter a new age of having multiple fundamental innovations come to the marketplace. But I think what we'll realize 50 years from now, when economists finally look at this, what they'll realize is that the bar So since there's no innovation process in economics, nobody sees this right now. And so it seems like with conventional things, I can play with the interest rate over a much wider margin than I should. And that's because the microscopic thing, the microeconomical thing that's changing, is that it's the bar for innovation. So if you lower interest rates too far, you encourage only incremental innovation. If the bar is too high, then only the largest, most fantastically beneficial innovations can make it across. And so what this suggests is there actually is a tighter window in which price stability is indeed the most important thing, and you probably want to keep it within some narrow range so that the innovation system doesn't get depleted or filled up. In other words, another way for looking at our innovation process with the 10 or 15-year window, because it takes time and it takes particular, it requires a bar of a certain interest rate to make the system fill up and run properly. If you drop the interest rate too far, it's kind of like having, here's our innovation pipeline, literally a pipeline, let's draw it that way. And over at this end, I have, a certain number of seeds that per unit time can be created. Then they, increase down here in time, and then they're ready to absorb dollars so that they can grow into huge parts of the economy and drive it. The assumption, in a very crude way, has been that, well, if we're running into trouble, we'll just keep on lowering the interest rate, and we'll produce more of these things, or more accurately, we'll pull more of these things out quicker because the money will chase them further down the pipeline and pull them out. But of course, that assumes that the production of these is first of all always much, much greater than whatever low interest rate could stop them from growing. It also says there's no feedback loop between interest rate and how many. So the problem is that when you put too much money in here, you deplete everything. And this thing's time, right? So once you bring it back up, you finally can restart this process, but it takes a long time to fill up, and there'll be a delay before you get growth again. So unfortunately, the longer we leave interest rates down here, the worse it is for innovation. Hopefully, what will happen is companies will get nervous enough about this that they'll actually start now doing some fundamental innovation. So after the crash, we'll already be partway in, and we won't have to experience the whole 10 to 15 year. So that is what's happening in the American ecosystem these days.